All right. I'm so excited to bring you the first issue of the monthly macro, your concise top-down guide to what's moving markets. We'll cover major macro updates across the US, Europe, China, Japan, and even South Africa, taking a look at some central bank activity, inflation trends, GDP figures, and various other trends from around the globe. At the end, I'll tie it all together with a curated model portfolio spanning equities, bonds, DeFi, and we'll cover some NFTs too. Yeah, whatever happened to those JPEGs? Well, let's find out. My name is Nobile Kumalo. Let's dive in. And of course, no other place to start as the trade war rages on as the two largest economies fight for global supremacy. This has been the biggest driver for the month, with new tariff activity between US and China rattling markets for much of the month. Investors oscillated between risky and safe haven assets at several points, triggering volatility in the bond yields, FX markets, and equity markets. Add to that some headline grabbing remarks from President Trump taking fresh aim at Fed chair over interest rate policy, and volatility seems to be poised to continue for some time. These political crosscurrents have added noise to what was an already complicated macro backdrop, undoubtedly making policymakers across the globe nervous as the tussle wages on. From a data front, let's take a look at the US macro activity this past month, where the Federal Reserve held interest rates steady between 4.25% and 4.5% in March, extending the pause that began in January. Policymakers acknowledged greater uncertainty in the outlook, but maintained their guidance for 50 basis points in rate cuts this year. Growth expectations were trimmed, with GDP now expected at 1.7%, down from 2.1%. While PCE inflation was nudged higher to 2.7% for 2025. The Fed also signaled plans to slow quantitative tightening. Historically, risky assets have performed well when the Fed has acted dovish. Look for local bonds, equities, and even riskier assets such as digital assets to rally in this event, something we're certainly watching out for. In the euro area, core inflation eased to 2.4% in March, the lowest since October 2021, matching preliminary estimates and coming in just below expectations. According to some onlookers, that should leave some room for the ECB to consider rate cuts, or at least adjust their expectations going forward. Overall, inflation has slowed to 2.2%, with energy prices resuming their decline and services inflation easing slightly. Among the bloc's largest economies, inflation cooled in Germany, Spain, the Netherlands, and Belgium, but held steady in France and picked up slightly in Italy. This is where things are always interesting in Europe. The divergent realities in the euro area remain a fascinating prospect to us, as inflation remains above the ECB's 2% target in many countries. Look at the following graph we put together showing just how much CPI has come down across Europe's leading economies. But it's the nuance that's interesting. Germany and Spain have showed a more volatile CPI print, often deviating sharply from consensus, pointing to surprise inflation shocks, likely from energy and wage pressures. France and Italy, by contrast, display a more consistent CPI path, generally tracking expectations. Overall, though, the trend is clear. Inflation is cooling across the board in Europe. On the GDP front, Spain's economy outperformed in Q4 with a 0.8% quarterly growth, driven by household spending and investment. Germany saw a rebound in manufacturing activities, but services remained soft and job losses continued. The Eurozone's composite PMI ticked up to 50.4, hinting at stabilizations, though new orders and confidence continued to weaken. Moving to China, the People's Bank of China also left key lending rates unchanged in both March and April, keeping the one-year loan prime rate at 3.1% and the 5-year at 3.6%, both at record lows. The 5-year LPR, a benchmark for property loans, has now remained steady for 6 consecutive months. These moves align with the PBOC's cautious stance as it and the world waits to assess the economic drag from renewed US tariffs before deploying further stimulus. That said, officials have signaled openness to further cuts in interest rates and reserve requirements. In Japan, the BOJ raised rates to 0.5% in January, the highest since 2008, and left them unchanged in March as it monitors the global environment. Governor Ueda reaffirmed the bank's readiness to step into the bond market to manage yield volatility. While wage growth has supported consumption, exports and industrial outputs were flat. Services sector inflation has kept overall CPI hovering between 3 and 3.5%. In South Africa, the story has been dominated by inflation fears centering around the now rescinded VAT hike. Inflation climbed 3.2% in February, a 4-month high. The SARB sees inflation averaging 3.6 in 2025 and 4.5 in 2026. Goods inflation remains contained, but services inflation has picked up, and VAT discussions have been rather heated. With the government having initially announced an increase in VAT and come under immense scrutiny from various stakeholders, the government has, as at the 24th of April 2025, reversed that decision after public and political pressure. Let's have a look at what the model portfolio looks like. The model portfolio contains some SA bonds and some soon-to-be down-weighted inflation linkers, as we believe the picture for a globally supportive monetary policy stance is going to make risky assets such as SA bonds attractive. In the same light, we have a high-conviction US equity bias, leaning towards some dominant themes such as tech, automation, digital payments, and defense, with names such as Nvidia, Taiwan Semiconductor, Coinbase, and Lockheed Martin standing out. In addition, we have allocated some risk to decentralized assets with some very exotic instruments in small scale added to the portfolio. Taking a look at the nominal bond curve, it's a complex picture, but the market is clearly showing preference in the belly of the curve. The dip suggests it's picking up bids, perhaps as some managers have reduced duration in what has been a sticky inflation and a politically uncertain environment. The other explanation could likely be issuance, which tends to dictate supply and consequently affect demand. The long end of the curve, in contrast, is finding it hard to pick up bids, as suggested by the steeper end of the curve. The ILB curve, in stark contrast, is showing a kink in the belly, reflecting uncertainty about medium-term price dynamics, especially with what was the ongoing VAT adjustment discussions and service inflation concerns. I also believe the substantially longer duration in the inflation-linked benchmark makes it difficult for many managers to stay within duration limits of their mandates. This states the need to move out further along the curve to get the necessary exposure, and I believe this is shown in the flattening of the ILB curve in the long end in particular. In terms of what we're looking for as April turns into May on the radar, we have quarter-on-quarter GDP figures out for both the US and Europe on the 30th of April. These data points will shape expectations heading into the mid-year. The Bank of Japan will make interest rate pronouncements on the 1st of May, with the US scheduled to release key unemployment figures on Friday the 2nd of May. Overall, however, look for tariffs and trade to dominate sentiment for some time. Beijing has rolled out new measures to support consumption and offset some of the impact of the trade tensions, while the US seems to be committed to its no-compromise stance. So this is likely going to wage on for some time. Well, that's all I have for you. Remember, NFA, this is my opinion. Speak to your financial advisor. This is not solicitation for you to buy anything, just some of my brain droppings. I hope you enjoyed this. See you in the next edition. My name is Mobile Kumalo. This was your monthly macro.